Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with David Hall of YFM Equity Partners to talk about the British Smaller Companies VCTs. Hello David, welcome back to the studio. Firstly, for those who aren't familiar, could you give us some background to YFM and your own experience?
So YFM is a business that's 40 years old now. The Y in YFM is from Yorkshire, although I'm a Lancastrian by birth. They've just about got over that in Yorkshire now, even though it's only 500 years. It is a little soon, but we are reconciling. I've been managing YFM for about 20 years. I'm the chairman of it now. And YFM specialises in investing in smaller unquoted businesses, and it's done that ever since the early 1980s. So obviously what we're investing in is very different to it was in the 1980s, but we've invested through pre-internet, post-internet, pre-mobile phones, post-mobile phones, and through all the different cycles in between.
And so we're here today to talk about the VCTs. What do they aim to do for investors?
So British Smaller Companies Venture Capital Trusts. It's the name's the clue. That's in terms of what they invest in, British Small Companies. And what they do, like all venture capital trusts do, is to try and find businesses where you can make value creation plays. So they've got to create the value, we then crystallise it, and that gets distributed through the trusts in terms of a tax-free dividend. So the trusts themselves generally tend to not produce capital growth. The capital growth that they do produce is through the distribution of dividends over time. And that's what we try and do, and that's what we've been doing for 25 years now.
Any particular characteristics that you look for in the companies you back?
Yeah, there's a couple of characteristics in UK small businesses, and which are not necessarily just generic to the UK, but you're really trying to identify. The first is that you've got a product or service that is delighting or pleasing customers, so something that people want, right? And the more people that want it, the better it is. So the bigger your addressable market, the better that is in terms of wherever the solution is. Doesn't always have to be revolutionary, though it can be evolutionary in terms of that, and I will no doubt talk about some of the businesses later. The second thing is about the people that are going to do that. They're going to try and execute their ambitious plans, and you're looking for people who are, I think, both a combination of ambitious and ideally self-questioning and deal with change. They accept this phrase that you know what you know and you don't know what you don't know, and what like one of those things about what I know is finite, what I don't know is infinite, and therefore I can always learn. So if you've got someone with those sorts of characteristics with a good addressable market, then you've probably got something where you're off to the races.
Yeah. Are there any red flags? Anything that would warn you off a management team?
I mean, I guess there are always some characteristics in entrepreneurs, but it's always hard to be, I think, uniform and one size fits all. As far as we have backed people who have not got those characteristics necessarily, as I said earlier. So we've had backed people who are very, very focused on just the goal themselves, and therefore, I guess, direct in their ability, so that they don't like change. But actually, we have made money out of that. But that's generally a characteristic that is more difficult to make money out of, because businesses do have to adapt and change as they grow, and therefore the ability of the entrepreneur to recognise that, I think, is absolutely crucial.
So David, is there a particular stage in which you invest in a company?
Yeah, I think so. I mean, typically the type of business that we invest in is a few years old, 3 to 4 to 5 years old. It's probably got about 20 to 30 people on average. It is an average. So it's sold some of its product or service. It's probably sold it a few times to people, so it's had some repeat customers, but it's probably yet to develop the infrastructure to be able to scale. And businesses build out their functions over time. So it's probably run by 2 or 3 people making decisions together in a single room, very short decision-making lines, And we get involved at that stage to help them transition to a place where the decisions will be made by lots of different people in lots of different places, with much greater functionality, wider management teams and deeper middle managements, and a whole series of resources to back that. So that's the stage at which we get involved, which you have to say is something where all those people are looking to try and change the future for the better for some people and grow and significantly evolve that. And that certainly gives an energy and enthusiasm both to those businesses and of course to us as investors.
So David, can you give us some recent examples of companies you've backed in the VCTs?
Absolutely. A really interesting business is one that's an employee engagement tool, and which the clue's in the name because it's called WorkBuzz. Right? And what that does is gathers information and data, allows employees to be able to give feedback to management teams, and then they can use that in lots of different ways. And the fact that employee engagement is an area which has been rapidly increasing, and then how you do that across large corporations and do that effectively is an area which I think has got significant growth at the moment, being driven by a combination of regulation and human behaviour. And that's a good sort of intersection to be at. So WorkBuzz is a recent investment, and it also passed that other test we look at for businesses, because the economic environment's not exactly been easy internationally or indeed locally in the UK over the last 12 months. But if you've got a business which has grown, nearly 100% in the last year, then you've got to ask yourself, it's kind of rude not to invest, really, isn't it?
Any more examples?
Yeah, on a different level. So one of the things that came out of sort of 2019 and 2020 is a business that operates. It's called BioRelate, and it operates in that life cycle for development of new drugs. So one of the things that we've discovered is that it's possible to develop drugs in a much faster speed and environment than it used to be, and there are lots of reasons for that. And this operates in the area where effectively it can pool together information on lots of historic data in all sorts of tangential areas, pull it together quickly so that you can identify and shorten your time to, from start to finish in drug development. That as a whole, our little bit in the cycle of that through BioRelate is an interesting place to be. But that as a whole I guess for the whole, if you look for the whole world, not trying to be too grandiose about it, but the faster that we can develop those drugs, the better that is for everybody. And also the shorter that timeline, the quicker and more money we'll be able to invest in that life cycle. So life science becomes an area which can attract even more capital as a whole than it does now. So BioRelate, definitely one to watch out for.
So turning to some of the more mature holdings in the portfolio, any particular highlights there? Matillion, perhaps?
Well, we could touch on Matillion. I'll touch first, if I may, on a business called DisplayPlan, which was invested in 2014, which is a business that you wouldn't necessarily have thought would do what it was going to do, because it effectively is point of sale display items in retail, which you'd thought is a tough market. But that was a business that we invested in, about 8 or 9 years ago now. It was at the time only turning over a small number of millions of pounds, making less than $1 million. So it's slightly more mature. This was a slightly more mature business. Mm-hmm. Currently, though, turning over north of 30 million, making 6. And if you look at that, that's matured as a business, grown out, created significant value, and that's actually been paying dividends back into the portfolio as well, which is a great example. Matillion is probably been one of the fastest growing and biggest businesses. That was a business that was based in Knutsford when we first invested, at 18 people there. Currently employs over 600, based in Manchester now and Denver. It's a data productivity tool, internationally available. Turnover probably now just north of 80 million, but still growing north of 30% a year as well. And that is a marketplace riding off the development of both cloud, so as more people put stuff onto the cloud and use the cloud, as well as the use of data. And the intersection of those two things is driving exponential growth.
So David, besides funding, how do you add value to your investments? How do you help these companies?
I guess having been around for 40 years, what we've seen is a lot of bumps in the road. And as I said, where we invest in businesses, they're going to scale up. So they're going to add the same sorts of functions. They're going to beef out the finance function, develop a marketing strategy, develop a sales strategy, and develop, probably if they're in software, because a lot of what we do is enterprise software, they'll develop our engineering teams and CTOs. So what we help with is all of that functionality. So we've invested ourselves in our own business, in a head of talent. We have a network, a whole group of functional specialists that can go in to help that development at different stages. We offer that as well before businesses invest with us. If they're looking to try and recruit particular people, we'll try and get people from the right stage of development for the right stage of business. And then we'll try and help them shape their strategy. So at the end of the day, the businesses have got to execute. They're the ones creating the value. We can certainly, though, help them crystallize it, having sold plenty of businesses over the years. And in those areas, we hope that's what helps. And then I think, not get in the way of ambition. From an investor perspective, not be afraid of growth. I think that's quite a big thing. I think particularly in UK PLC, where sometimes we can hold short-term financial performance and short-term dash for profitability ahead of ultimately growth and creating globally competitive businesses.
So changing topic slightly, looking at the current environment, we've got higher interest rates, higher inflation. Is that affecting the way you invest, and is it affecting your underlying companies?
It's not really changing the way we invest, because the nature of what makes a good business is the same irrespective of the economic cycle in terms of a global addressable marketplace and the type of people you want to run the business. It does change a couple of things. One in particular is around the way that entrepreneurs tend to think. So currently, now the market's moved where 2020 and 21, perhaps even last year, people are looking to sort of raise money and then raise it again a year later and then raise again a year later. The market conditions are different now. So the entrepreneurs are looking to raise money for, to give themselves 2 to 3 years worth of runway. So they're asking for slightly more money than they're asking for before. Because the reason they want to do that is they want to forget about the financing risk and get on with executing the plan. Because one thing that you are seeing is a slight sort of tightening in corporate belts. So the markets are therefore tougher. But for entrepreneurs with good products, that is a great time to get more distance between you and your competitors. When everyone's doing well, it's much harder to sort of differentiate yourself from the pack. Right? When times are a bit tougher is when actually you should be pressing the accelerator. So raising a bit more money at this point in time, right, for the entrepreneur puts that to bed, and they can get on with executing their plans. So what we're seeing is a slight increase in both deal flow and in the amount of money that people are asking for.
So David, where are you seeing the strongest opportunities at present?
That's a great question. I think where opportunities come from now is very different to where it was coming from anyway 5 or 10 years ago. Particularly last year, over 60% of the investments that we made were ones which I suppose were called self-originated. So we have an origination team that picks out those things. And those businesses we saw or got to know between 12 and 24 months before we actually made the investment. And the nature of that means that they come from lots of different places. They might have had earlier investment by seed investors who invest smaller amounts of money before they develop. So there's lots of angel clubs. There's businesses that come to us direct. We run sort of entrepreneur out programs. We run webinars which people can come to where we run topics that we think are hopefully interesting for CEOs. But interestingly, the topic that was most well attended was actually one we did on neuroscience, which was the way that brains work and understanding how people's behaviour works. That was really well attended by CEOs who didn't actually weren't invested with us at the time, and that sort of thing is a thing that tends to bring in investors. So it's no one particular market. As I say, we're enterprise software. Is predominantly what we do, but that is enterprise software on a globally applicable scale. So they can arise anywhere. So all the businesses are in the UK, obviously, but they come through all sorts of different touch points.
Okay, that's interesting. So it's about that outreach and that engagement with
Absolutely, and getting in and getting there early and being interested in their businesses at a point where they're not asking us for money, I think also helps set the basis of a future relationship that's probably going to last 7 or 8 years.
So what are the biggest challenges you face right now?
That is a great question overall, because the businesses tend to face slightly different challenges than they were doing 5 years ago, which is, I said, maybe the nature of corporate belt tightening, so they've got to get bigger marketing funnels to get in. So the balance that we have to achieve now, which is probably the biggest debate we have, is growth versus capital efficiency. 2 to 3 years ago, it's all about growth. Growth is everything. 100% growth is much better than 20% growth. Spend as much as you can to get it. Getting that balance right now, entrepreneurs to say, but you've got to grow and grow in a capital efficient way, is the hardest conversations that we have with entrepreneurs, because it's an allocation choice that you have. There's a finite amount of money here. What's the best that we could do with that? That doesn't mean that we don't further invest with our businesses. We often invest 2-3 times with businesses before we eventually realise that. But those conversations about you've got to choose are probably the hardest ones that we have. I guess the other thing, as I've mentioned earlier, about how investments come in origination, and it is a bit, maybe it's a little bit trite to say it, but as a challenge. But actually, the number of entrepreneurs at the moment who are looking to raise money and looking to raise more money for the future, who are actually got businesses that are growing, is quite significant. So getting some of our team to say no to some of those great opportunities is also a challenge as well.
Very interesting. So turning to risks then, how risky are these VCTs? If, say, for every 10 companies you back, typically how many do you expect to fail? How many are going to make it?
Yeah, the concept of making it is quite interesting. The nature of what we do, it comes with a lot of risk. So if you were to look in terms from an investment perspective, then probably about 1 in 10 you might lose all your money on, and then between another 2 or 3, you probably will get not your money back, or you'll get a proportion of your money back, and you have to work quite hard to get it back. And then of the rest, you'll have varying degrees of success in terms of the multiples that you will get from them. But it does vary within the cycles, and we try and the ones where we lose all of the money, which I said sort of the 1 in 10, is usually because there's been a big shift in the market. Now the interesting area is in terms of how we can try perhaps to manage the investment risk. You can't take the business risk away. Is then what we can do for those those sort of 2 or 3 that might go on where we wouldn't get all the money back, and how we can help them adapt to try and minimise that risk. And therefore, I think that helps manage ultimately the investment risk, but the underlying risk that the businesses face, there isn't a lot we can do to change that. But that's the sort of outcome that you get. That and hopefully that continues to deliver the performance as we've done over the last few years.
So what about exits, David? Any recent exits in the portfolio?
There've been a few, and it would be very easy for me to sit here and talk to you about the exits that were really good and really strong returns for investors. But I'm going to pick one which probably exemplifies a few other different things. A business called Vualta that we invested in. Vualta as ERP business, it's called. It's an enterprise software consultancy, but had an app with it, right? And the app was to help them deliver their consultancy in a more efficient manner. What they did was, there were 2 very different businesses. One was product and one was consultancy. The app we thought had value in it. The consultancy is what we were going to try and drive the growth out of. That business, we got approached to buy the app. And what we had to do was separate the organizational structure, separate the legal structure of that, which we had to do that at pace in order to be able to effect the sale of the business. And it involved, we had at peak, we probably had 2.5 FTE full-time equivalent people working on this transaction. Sold the business to a US private equity, the app business, to a US private equity business. That delivered a 1.5 times return on the total investment that we put in to the investment in the first place, and left us with an investment in the consultancy business that is now bigger than the first investment we had, and in slightly better terms as well. So that exit was quite a hard work exit. If you look at it on the face of it, 1.5 times isn't a great multiple, but it exemplifies the amount of effort sometimes you put in terms of the portfolio to help these businesses execute on that. And I think that produced a great result overall. So not only do we have a great investment return on that, but we've still, as I said, we've got a bigger share in the existing consultancy business, which is the bit that we're backed there, but it's helped us evolve the team of the consultancy business as well. So yeah, so Vualta still in the portfolio, but actually I think a good example of a really good exit.
And the performance of the VCTs as a whole, how are they performing recently?
They've been strong. We've remained consistent. There's an AIC chart that we look at, as the Association of Investment Companies chart, which shows that we remain sort of number 1 and 2 in terms of consistency over 1, 3, 5 and 10 years. I think what's been driving the performance, because the dividend levels have been fairly strong, net asset values have been reasonably resilient, and I think that's a function of the underlying growth in the portfolios, plus the quality of some of the exits, and that's offset reductions in multiples that we've seen. So the net of that is performance has been pretty strong over the last 2 to 3 years in what some people I think have found quite a difficult environment.
And you mentioned dividends there. Outlook for dividends, are you still confident you can pay consistent dividends?
Confident the word's played well. That's from an illustrative projection and talking to my compliance officer. It's always a very difficult question to answer that, Jonathan. So the dividend performance, we don't set a target on dividends. I haven't done. Historically, the VCTs have delivered over 1, 3, 5, 10, or if you look even further back than that, yields of between sort of 7 and 9%, depending upon the time of the environment. They are a bit cyclical. They do go up and down. They're a bit volatile. You can get the odd large dollop of a dividend that gets in, which is a function of venture investing when you get a big return. But typically, they've stayed within that sort of range, and the underlying performance has stayed within that level. And we've not changed our approach to how those businesses, how we support those businesses. Those businesses themselves haven't changed their operating dynamics. So if you take those things together, we're hopeful that that they can continue to be able to deliver that sort of capital creation that produces the tax-free dividend flow.
So to sum up then, David, for those that want to invest in a VCT this year, why should they invest in the British Smaller Companies VCTs?
Well, British Smaller Companies VCTs, I suppose I have 2 or 3 things that you'd kind of pick out. The first, I said, we sound like a specialist because we invest in largely in enterprise software. It's about 80% of what we do. All right. So you get a portfolio diversity, which is always good. You might have 40 odd assets or more in the portfolio. But because of the nature of what we do, you get 2 other forms of diversity. The first is because it's enterprise software, it's a global element. So we are probably more dependent on the performance of the US economy because we've got a high level of exports in that than we are the UK. So you're getting effectively a geographical diversity that added to that. The third thing that you get is you get a sector diversity as well, because the end use for all this software is across multiple sectors. Right, so you also get a third layer of diversity in terms of whether we are supplying either media at one end or public sector at another, or aviation industry, education or medical, all of those sectors. So you get that differently by the end use. So you get 3 levels of diversity, which I think is quite attractive, and particularly in the current environment.
David Hall from YFM Equity Partners, thank you very much.
My pleasure, Jonathan.
If you are watching on YouTube, please press like and subscribe to the channel for more.